While we're on the hunt for investments that pay us, business development companies or BDCs should be on our list as many of them are currently paying over 10%. However, recently they've fallen out of market favor due to potential risks in credit, the Fed starting a rate cut cycle, and general market fear. Given those headwinds, should we still be considering BDCs? To find out, hit that subscribe button and join me today as we examine business development companies right here in the red zone. BDCs are regulated investment companies that provide credit to small and medium sized businesses. They avoid corporate taxes by distributing 90% of their income to their shareholders, which means that we can expect BDCs not to appreciate much in price, as most of their return will be their payments to you or I as shareholders. In general, the higher the current yield of a BDC, the more credit risk is present with the borrowing companies. Although in the short term, the market can obviously carry inefficiencies that fail to reflect that general view. Now, as I alluded to in the opening, recently the price for BDCs has declined for a few reasons. First is the current interest rate cycle where the Fed has started to cut, and the belief that BDCs will reduce their distributions because they will either receive less in interest payments due to the floating rate nature of their loans or provide fixed rate loans to companies at lower rates. However, what might also be true is that BDCs will simultaneously experience less defaults, as some of the more riskier companies should have an easier time paying off their loans at lower rates. Here's a look at how the distribution of an ETF that tracks the index of BDCs, ticker symbol BIZD, changed during rate cut cycles previously. It looks like the change in the Fed funds rate is highly correlated with the distribution of BIZD at about a 0.78. So, whether it's the rate itself or the poor economic conditions driving more defaults that are generally present when rate cuts are happening, we can expect dividend cuts. Now, how much could we expect? It looks like our minimum payout during this period, which started in October of 2013 all the way to present, was just shy of about 32 cents for a quarter. If we bought BIZD at its current price today of around 13.85 at the time of this recording, it means that our reasonable worst case for forward yield could drop to around just over 9%, which is still above the target of my red zone portfolio of 8%. So, just the fact that the Fed is cutting rates in and of itself isn't a reason to stay completely away from this asset class. And although you would potentially be getting a lower yield than we've seen recently, it's still above 9%. The second reason for the price decline is due to the recent bankruptcies of First Brands and Tricolor. Here are some publicly traded BDCs who actually had exposure to First Brands. Now, defaults are definitely a risk we need to pay attention to, and what is riskier in private credit is that it's more opaque than public debt. Although that hasn't stopped public debt from developing into crisis levels previously. But before we think this type of exposure risk is limited to BDCs, take a look at this list of all the financial institutions, including Bank of America, that had at least some exposure. Now, when it comes to Tricolor, the main lenders were actually not BDCs, but traditional banks like JP Morgan and Fifth Thirds. Overall, these two bankruptcies are estimated to represent less than 0.05% of the total BDC sector's assets under management. And although Mr. Diamond may be right about the cockroaches, so far we haven't seen this develop into any wider crisis. We definitely might, but historically, the reported default rates of private credit, estimated to be about 2%, are lower than that of public credit, which is estimated at 3.6%. Although recent research by S&P Global indicates that's mostly because private credit often is more flexible, meaning there are ways for borrowing companies to avoid total default due to more loosely defined covenants, allowing for maturity extensions and payments in kind, which is considered selective default, but generally not reported in the overall default rate. So, at a minimum, we should probably think of them of being roughly the same or private credit being slightly higher. But unfortunately, due to the nature of private credit, data is much harder to come by for a macro level view for at least a retail investor like me. Regardless, at least historically, defaults are not more likely to be significantly higher in the private credit market. There are a few other recent warning signs, though. For example, last week, Blue Owl Capital, one of the US's largest private lenders, called off a planned merger to combine two of its debt funds, OBDC, which is their publicly traded BDC, and OBDC2, which is not publicly traded, after the private fund investors would have lost about 20% in the merger due to the differences in the current price if the merger went through. And then finally, there's, of course, numerous articles and YouTubers warning us that this is a precursor to the next great financial crisis. The truth is, there's no way to know. For example, the AI bubble that was supposed to be bursting for several years now. But I will say that the opacity into most of the world of private credit isn't exactly helping investor confidence at this particular point in time. So, is this setup from rate cuts, defaults, market volatility, and large lenders walking back fund mergers enough to keep us out of BDCs altogether? That's obviously up to you and your own research. But for me, those risks aren't enough yet for me to entirely avoid this area of investment, primarily because bankruptcies in the world of credit are not new, and in private credit, lenders entering these arrangements are expecting some portion, now likely in the single digit percentage wise, but some portion to default every year, and it's why the returns are higher than the risk free rate. Second, as we don't really expect asset prices to move as much as our returns are expected to come primarily from distributions, recent 15 to 20% declines in price present a likely best opportunity to invest in these assets. It does, however, tell me that indexing is probably not the right approach, as an index fund would simply allocate some percentage based off market cap, which would not examine the quality of the individual underlying assets. So, something like BIZD is out for me. However, I also don't want to add potentially more risk to an already risky area of investment by trying to pick just a single BDC and ending up with a higher default exposure. This seems to be an area ripe for active management, where we desire both exposure to more than one of these income producers to avoid that single stock risk, but also demand high quality of the underlying holdings to avoid an index giving us poorly managed companies. Ticker symbol PBDC is the largest actively managed BDC ETF. Looking at its holdings, it mirrors BIZD but eliminates allocations to some of the more risky BDCs. As Kane Lee points out in a Seeking Alpha article from October, PBDC seems to look for BDCs with low debt to equity ratios, BDC portfolios that are mostly structured as first lien, BDCs with a history of growing or consistent dividend payouts, BDCs with less volatility in net investment income levels, and BDCs with overall diversified portfolios. Now, one thing that tends to turn off new investors to this space is the published expense ratio of PBDC of 13.49%. If you're saying that can't be right, you would be correct. That 13.49% is more of a reporting anomaly due to SEC accounting rules, and PBDC's actual management fee of 0.75% is what the fund is collecting. Regardless, the yield is calculated after fees and comprises the vast majority of the total return, so you're getting today over 10%. Now, as I am under 10 years from a potential transition to more recreational employment, I'm starting to transition my portfolio to a more blended approach and including an income component with a 40% portfolio allocation, targeting a yield of around 8%. The point is to facilitate an earlier retirement by providing an income source to bridge to later milestones, avoid initial sequence of return risk, and continue to provide for consistent spending throughout retirement. As I was initially looking at this asset class, I was considering investing up to 6% of my total portfolio here. but the headwinds that could spell doom have curbed my enthusiasm. So at this point, I've decided to just start an initial position up to 1% in my overall portfolio to PBDC and will eventually target 3% if the current fears are overstated. I'm willing to lose some upside by mostly passing on the opportunity to buy my full target now, rather than lose the majority of my investment if private credit is the next big crisis. But I'm also unwilling to completely sit on the sidelines, which by the way is also why I have a large position in an S&P 500 index ETF even though we may be in an AI bubble. In summary, for BDCs, I'm dipping my toe in the water. So, what do you think of the current headwinds for BDCs? Do you think they will cause the next financial crisis? Or are the recent headlines exaggerated? Are BDCs the right investment for your portfolio? And if so, do you hold an ETF like BIZD or an individual BDC like Capital Southwest or Ares? Feel free to leave a comment below to let the community know your thoughts. If you're interested in other high yielding assets yielding over 9%, check out this episode on preferred equities. Until then, I'll see you next time right here in the red zone.